Welcome to On the Investor's Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to understand what investors are thinking about right now and how that fits in with building the right portfolio. Well, Happy New Year. As we kick off 2026, I want to discuss what investors should have as their New Year resolutions when it comes to portfolio construction. Now, first, I have to confess, I am not a believer of New Year resolutions. If something is important, such as quitting a bad habit or starting some self-improvement, you should start right away, regardless of which month it is. You don't have to wait until Jan 1st to start it. If you have to wait till then, it's probably not that important. And the lack of urgency explains why many New Year resolutions don't last very long, maybe a few months or even just a few weeks. But since we're at the start of the year and these are important actions to take, I'm happy to give you some novelty characteristics if that gets more people to think more seriously about how to improve their portfolio construction. Now, very simplistically, we see global investment backdrop is steady growth, some room for monetary policy to ease, but valuations in some assets, especially part of the US markets and corporate credits, are reflecting a very positive outlook. This potentially limits the upside in returns, but also does not allow for a huge amount of margin for error. Now, this may not be the most exciting resolution, but in line with our 2026 market outlook, staying disciplined in investing is a pretty good way to start the year. There are three things that investors should include as part of this resolution. First, continue to look for ways to diversify your portfolio. Now, in my conversation with a lot of APAC investors, the equity diversification involves the US market plus their home market, what I call US plus one. There's no doubt that the US market has delivered strong returns in recent years, especially through technology. But I think there's clearly more than just technology in the US. The financial sector can benefit from a steeper yield curve, a pickup in investment banking business such as M&A and IPOs, and also windfalls from potential deregulations. For other industries, but policies towards national defense could also boost industrial sectors. Tax rebates in the first half of 2026 can also help some consumer stocks. Then back in our region in Asia Pacific, global AI development should continue to support overall export performance, which correlates strongly with earnings growth in this region. This should continue to support Taiwan, South Korea, and Japan. Meanwhile, investors will be closely monitoring potential breakthroughs in how China adopts AI in its services or even in manufacturing. Second, investors need to take portfolio rebalancing more seriously. In the past 3 years, S&P 500 was up almost 80%. The total return of US Treasury is about 11% over the same period. Therefore, a 60-40 stock bond portfolio with S&P 500 and US Treasuries that started in 2023 would look more like 70-30 without any rebalancing at the end of 2025. Now, this could mean the portfolio could be taking on too much equity risk that's appropriate for the prescribed allocation. Now, there are good reasons to remain optimistic about equities and other risk assets, but we still need to stick with our designed game plan to reach each of our financial objectives and not get distracted by past performance. Third is income generation. Equity returns, as I've mentioned earlier, have been impressive in the past few years, but given current valuations, it's rightful to expect a more modest return in 2026 with a higher level of volatilities. A more consistent income stream from fixed income, stock dividends, alternative assets such as real estate and real assets, and options overlay strategies can help investors to address these rising challenges. Now, in the past, stocks may be up 15-20% in capital appreciation, and therefore that 5 to 7% income may not seem particularly attractive. But if equity returns ease towards single digits or in the low teens, this level of income would become much more meaningful. So hopefully this gives you some ideas on what to put on your 2026 to-do list when it comes to investing. Of course, you can reach out to your JP Morgan Asset Management client advisors for more ideas and solutions on better ways to build your portfolio for the new year. Again, wishing you a very happy and prosperous 2026 and look forward to meet you in person in the months ahead as I travel through the region or discuss what's on investors' minds through his podcast. Of course, you can also get our latest research from JP Morgan Asset Management's website. Just look for market insights. So thanks for listening. If you enjoyed this podcast, please share this with your friends and colleagues and also consider subscribing. If you have any topics you want us to cover, please reach out to your JP Morgan Asset Management client advisors. I'm Tai Hui. I'll see you in our next episode to discuss what's on investors' minds. Meanwhile, stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.